Today, I'm about to break down a crazy 5-step process that's going to change the way you see trading forever. Now, I don't want to burst your bubble, but there is no best strategy out there. And all these YouTube videos talking about this is the best strategy that made me this is BS. Trading is 95% you and 5% your strategy. So even with a 99% win rate strategy, most traders will still find themselves facing the same issues. So today, I will share with you a 5-step process that you can implement to better understand the strategies you are using and get more confident and comfortable with your process. Forget the myths. It's time to dive deep and make trading work for you. Let's jump onto the charts. Okay, guys, so I'm going to share with you a 5-step process. And the first thing that we're going to be looking at today is finding commonalities. And I'm going to share 5 examples. So make sure you stay to the end to make sure that we can get to the 5th point here, which is building your strategy and bringing it together. Okay. So the first point or process or step in this process, should I say, is find commonalities. We need to be able to identify recurring market trends and conditions. So the first example that I want to take a look at is on pound JPY. Now, for the record, guys, there is a disclaimer at the end of this video that if you stay to the end, you will hear and you will fully understand what it is that I'm trying to explain to you today if you don't get it from the onset. So here we're looking at pound JPY on the 5-minute time frame. Now, the time frame is not relevant to this training. What we want to be focusing on here is what we're seeing in terms of commonalities. Now, this is clearly a downtrend. We have structural highs, lower lows, lower highs, lower lows, lower highs, etc., etc. Now, take a look at this for a second. What commonalities can you see here? And how can we build a strategy based on this? Well, it's very easy to say, oh, this is a trend. This is trend trading. But if we look at it from a perspective of just being trend trading, then we definitely are not going to be able to build a strategy that's long lasting because it's too subjective. What we want to do here is look at the commonalities. So let's just take, for example, this structural high. This isn't the first point of contact here. We can see that price in this scenario is failing to break a structural high. This is what we call a behavioral perspective here, or a behavioral shift. We can see here that price is trying to break a high. We're continually failing, and then we have a shift. Now, once we have this shift, this doesn't necessarily mean that we're in a downtrend, but when we have a structural low that eventually gets broken by price action, now we can start to assume that the behavior of the market is now shifting. So when we see this, what can we start saying to ourselves? Well, we can start to assume that we're moving into a downtrend. Now, does that make this the first point of contact? Well, absolutely not. What we need to see here is commonalities. So what we're seeing as common in this scenario is we failed to break the highs. The shift in behavior has broken the structural lows, meaning that there's a higher chance we're in a downtrend. Now we have a pullback to an area in the market where we can find 2 points. Now, once we have these 2 points, this is an indicator to us that just as price is failing to break the structural highs, just as price is failing to break the structural lows, i.e., or meaning consolidation, when we break it, there's a higher chance we continue down. In this scenario, we're failing to break this structural trend line, brick wall, whatever you want to call it. There's a commonality that is in play, meaning that if we have 2 points of contact, there's a higher chance that if price comes back to this area, it's going to fail to break it, meaning we can now start to develop a trading strategy based on this. So what do we mean? Well, once price continues to do what it has to do, leaves the structural area, eventually when it comes back to this area, we can start to say to ourselves, well, there's 2 points of commonality here. If we see that price is coming back, we can assume, because it's always an assumption, there's no guarantee, by the way, we can assume that there's a higher chance that price can continue bearish. There's many ways we can approach this. When price comes as close to this area, you can enter this trade, keeping your stop loss above this brick wall, meaning that if price breaks it, it invalidates the commonalities, and then you can execute the trade like so. You can say to yourself, well, actually, I'm the type of trader that likes to look for more confluences. So as well as the commonalities and the behavioral shift, I would like to see price closing at this level. So it could look something like this. You might say to yourself, well, hold on a minute. I'm more of a scaling down technique trader. So if I want to enter this trade, I want to see areas of multiple wick rejection. So you can maybe scale down to a lower time frame, and it doesn't necessarily need to be the one. But when we come down here, we have the 2 points of commonalities. We can see that price now, from a behavioral perspective, is showing signs that we're failing to break the structural highs. This is just a behavioral perspective, guys. This is not subjective. This is what happens every single day. Failing to break the highs, failing to break the highs. So we just bring that together over here. We're failing to break the highs. And now you want to see a shift. So the shift could be a bearish candle close. So now you put this above the high. And now you have a trade. Okay? Don't care about the risk to reward. That's down to you guys. You can say to yourself, well, hold on a minute. I don't necessarily need it to come exactly back to this area. But if I start to see a shift in and around this area, then I can take the trade from here maybe, as long as my stop loss is above here. Because if my stop loss is above here and it comes back, if it violates it, then it invalidates the trade. But if it doesn't violate it, then I'm still good for the trade. So then you can take the trade like so. Now we can continue this, moving back over to the 5-minute time frame, and we can see that the first trading opportunity was around here, whether you use scaling techniques, patterns, behavior. But in line with the commonalities, which is the theme here, we can see this is tradable. Now, what happens next? We can see that price comes back in and around this area. It doesn't matter where price comes to. If you feel, again, confident that there's commonalities and you feel like price is continuing to hold this in line with the trend or whatever it may be, here is another trading opportunity. You may say, well, I'm never taking the trade unless price comes back and touches this area. Okay, well, we have a touch here. We have price showing signs of it failing to break. And then you have another trade here. How is this developed? Well, it's simple, guys. This is not a trading strategy that is the holy grail. All we're simply doing here is finding commonalities. This was created. This is where it is validated. This is the behavioral shift after there was a commonality of price failing to break. And then price comes back in and continues to show signs that that commonality is still in play. That's all a strategy is. A strategy is simply something that happens over and over again that you identify and you execute based on that. Okay, so this is the first example. So if we go back over here, find commonalities, identify recurring market trends and conditions. Now we can move on to the second point, trade with the bias. What we want to be doing when we're trading with the bias is we want to align the trades with the prevailing market direction. So let's take a look at Aussie dollar USD as an example. And here we have a clear trend in market. Now, again, it doesn't matter what time frame you're on, guys, but the first point we want to look at is the commonalities. So here we have the first point. Here we have the second point. Now, you might say, well, how did you know it was going to be that point, Rox? Well, guys, listen, I'm not going to get caught out in this. In terms of TA, in terms of what I do, I've had so many years experience. I'm telling you now, there's no shiny object syndrome over here. I'm just being brutally honest with you on how you can approach the markets. I don't need you to give me views, and I don't need you to click likes. I just need you to understand how this works, because my focus is not to solely teach you a strategy, but to help you to become a better individual in terms of self-mastery whilst becoming a trader or whatever event you're in. And if I can help you here, then I can help you in other areas in the future. So for those that are going to critique me and say, well, Rox, wasn't that the commonality? Well, absolutely. This was the commonality at the time, right? Let's say that's a commonality. Here, let's say we take the trade based on the fact that price just comes back here. Would this have been a losing trade? Absolutely. But losing trades are part and parcel of the business, right? So I don't care if it's a losing trade. The minute you see that a commonality is invalidated, then it's invalidated. You just take a loss for the day, you walk away, or you just don't trade it, period. But what happens now when we have this point of contact and this point of contact? Well, we have now 2 points of commonality here. Now we are also identifying in terms of structure. So moving on to the second point, we have a trend. We have price breaking the structural highs, making a higher high. And we also have price making higher lows. If we incorporate the previous example on GJ, which is price failing to break the structural highs and lows, we have here price respecting the structural lows. Then what are we looking for? Well, we're looking at now for simple commonalities in line with this trend. So the bias is always going to be biased. And what do we see? Price comes back to this area. We have another point in this strategy that we're building of commonalities, and we add the bias, which is a trend, which is making higher highs and higher lows. So if we enter the trade here, put our stop loss below the low, we don't need a 4 pip, 5 pip stop. You don't need a 3 pip stop loss for Aussie dollar USD. 5 pip, 4 pip is comfortable. Take into consideration pips, spreads, and then you have a trade. Okay. We might say, well, no, hold on a minute. I want more of a shift. Okay. Well, there is more of a shift. Now you have structure to work with in line with the trend, which is a higher low. There's another trade. Now you might say to yourself, well, Rox, what if it never comes back here? Well, that's completely fine, guys. Maybe you want to just shift on behavior. Let's say now we have an area in the market where price is failing to break. You finally see that price is breaking the structure. Now, it hasn't come back to the point where we've seen the commonalities, but it is in line with the trend. Well, enter the trade and pop your stop loss below where the last point of contact is, where if it comes back to this area, you're happy to be stopped out. And then you have another trade. Now, because we're using commonalities and we're using a trend, we know this is an uptrend. So as long as price is respecting the previous higher low or the support in the uptrend, now you have areas that you can be entering the trade anywhere along this line, as long as your stop loss is below the point, the last point where you're happy for your trade to be stopped out in this uptrend. And here's another trade. Okay. So going back to the points, we've looked at the commonalities, and now we focus on trading with the bias. Looking at Aussie dollar USD, there's many ways to do this. You can trade it off of the support levels in an uptrend, the common points in the trend, or you can use breakouts in line with the trend, as long as you're following the rules and respecting the principle of your trading strategy, which simply means that it must be below the point where the trade becomes invalid. Okay. Moving on to the third point, trade with the behavior, understand and capitalize on the market psychology and sentiment. Guys, this is, and I can't stress this enough, is the most important thing you can do as a trader. As well as everything else, if you do not trade with the behavior and understand and capitalize on market psychology, you're in trouble. What do I mean by that? Well, let's look at gold for an example. And I want to make this very clear, guys. Whatever is out there, whatever. I'm not here to get on anybody's back. It's not my business. I'm just tunnel vision focused on my journey, okay, and my success. And for those watching, your success as well. I don't know where the levels are in the market. I don't know where the special levels are, the money is, or whatever. And I couldn't care less. I'm trading simply price action, technical analysis. I'm looking for commonalities. I'm trading with the bias of the markets, and I'm trying to understand the behavior. It's that simple. So let's take a look at this. We're looking for commonalities, okay? So what we can see here is this. Price is showing signs of making a structural high and failing. Now we have a commonality. We have price creating a higher low and failing to break the low. Now we have a commonality, okay? So let's say we're looking to trade this. If we're trading with the bias of the market, which at this moment in time is up, then what we're looking for is buys. So we have our 2 points of contact, which is our commonality. And then we have our third point. However you trade, this is entirely up to you. But let's just say, for example, you're the trader that waits for the candle to close. Here is a trade. Now, let's say you take the trade like this. You might say, well, Rox, it's only a 1.6 risk to reward. It's not favorable. Well, it's up to you. However you trade is how you trade. But the point is here, we have a third point of commonality. Okay? We can clearly see prices failing to break the highs and break the lows. Even if you don't want to take the trade like this for the reasons that I've just mentioned, because you don't have a favorable risk to reward, then start getting good at your scaling down techniques. Let's go to the 5 minute as an example. Okay? Here we have an example. Again, first point, second point of contact, failing to break the lows, failing to break the highs. So we classify that as a consolidation straight off the bat. And here you have an example of price breaking out and breaking back in with a nice bullish close, stop loss below, and target to the top for a 1 to 2. If you want a more favorable risk to reward, again, you can use scaling down techniques, going down to the 1 minute time frame. And I don't encourage you all to go down to the one time frame just because you can get a better risk to reward or a better stop loss placement. Only go there if you're comfortable with it. So let's say Again, for the critique, here's your first trade. Oh, we lost. Stop loss. Okay. Let's say we just continue to trade. It's Monday. We lose a trade. We continue to do the same thing. Another trade. Commonalities, right? First point, second point, and here's a common point. And the market structure is bullish. So we're taking buys only. And there's your trade. Let's go back to the 15-minute time frame. And let's just take a look at this again. Now, there's a first trade. First trade. Now, let's say the commonality is the trend is ending because it's failing to break the structural highs. Now I'm looking for sells. Okay, well, we look for the sell. Oh no, we lost this trade, guys. Oops, it happens. Now, what we can see is that what was once common is no longer becoming common because it's not respecting the commonality of the structure. Here we did, here we're not. So what we can do in a situation like this is we can start again. We can remove this and this, and we can say to ourselves, okay, fine. So what was once common is no longer common. We can see that the uptrend is now depleting. We're seeing signs of price showing rejection at structural highs, and now we can start this again. So here is one point. Here's the second point. We can incorporate both those points together. And then we can say, well, where's the third point? Here. So now we have price failing to break. And now more than just looking at this as a commonality or trading with the bias, we're now looking at behavior. From a behavioral perspective, we can see that price is failing to break the structural highs and failing to break the structural lows. Incorporate that into the other two steps. And let's say, how do we trade this? Well, again, we can see price is failing to break or creating a structural high, failing to break. And now we have a commonality. Bearish close. And here is a trade. Okay. How do we continue this? Well, the behavior is a consolidation, failing to break the highs and lows. We get back to the lowest point here. And again, what do we see? A reaction off of that area. However you take this trade is up to you guys. But let's just say, for example, this is it. And this is another trade. Let's say, again, the behavior continues because that's our focus here, behavior. Failing to break. Here. Here's another trade. Okay. Let's say now we're continuing to follow behavior because we're in a consolidation and nothing changed yet. Here is another trade. Okay. So what we're doing here, guys, is we're incorporating the commonalities. We originally was trading with the bias, which was an uptrend that depleted and failed to break the highs. And then we focused on behavior. Okay. Behavior is failing to break the highs, failing to break the lows. Uptrend ended, commonalities back in play, and let's trade with the commonalities. A simple process that happens all of the time. Make sure you incorporate this into your strategy when building one. Let's look at the fourth point. Include patterns. So an integral part of creating a strategy is identifying frequent patterns that form all the time. This doesn't necessarily need to be the basis of your building a strategy, but it can be included. So let's look at CAD-JPY. What do I mean by patterns? Well, this is how we simply do it. We identify here an area where price is failing to break. We find an area in the market where price is reinforcing that commonality. Here we see an uptrend. So we may avoid these 2 points simply as a pattern because we're trading with the bias. But now the behavior is illustrating to us that it's failing to break off of the back of an uptrend. So we can start to assume now, guess what? There's a depletion in that uptrend. We have a higher low that we expect price to respect that it doesn't. So we have the break. And then what do? We have price come back into this area. Another commonality, but it's a pattern. Whatever you want to call it. Triple top, free top, hood top, trap top, don't care what top. Okay. You might recognize this as a triple top. That being said, you incorporate the commonalities, the bias depleting, which is failing to break, the behavior, And now we're incorporating a pattern. You can call it whatever you want, guys. That's what everyone does. Okay. And then here's your triple top. And there's your trade. Now there's many patterns: break and retest, double top, deep pullbacks. No, goodness knows, whatever. I don't care. The point is, this is how you can form your pattern. So if you see this often, and more often than not, or it has a favorable risk reward, then you can trade this, right? Pretty simple. You can incorporate this into your trading strategy. Let's move on to the fifth point: building your strategy and bringing it together. Okay. It's very important that you understand the elements that we've just gone through, the other 4 steps in building your strategy. You want to synthesize insights that you've been able to develop on to really craft a cohesive, personalized trading approach to yourself. And the reason why I say that, guys, is because you may learn my strategy, somebody else's strategy. You may build your own strategy. But what you're going to have to do over time is build it to fit you. Because how I trade it is going to be slightly different, unless it is rule-based and there's a blueprint. Most of you at this stage will not build a rule-based blueprint strategy until you've gone through 30, 60, 90 days of really deliberate, intentional data analysis. Okay. But this is the start. Let's look at the final example in GU. How do we bring this together? Well, here we go. We have an uptrend. We have a higher low in what we anticipate or expect in an uptrend. We have a structural high, which is expecting an uptrend, and a higher low is what we expect in an uptrend. What we have here is price continuing to push in this uptrend, but breaking. So now if we're trading this, let's say as an example, and we're looking for the 3rd point of contact here, we might look for, let's say, a buy off of here. Let's say that trade is a loss, because in terms of the commonalities, this didn't work. Now, if we move over to the 2nd point, which is trading with the bias of the market, what are we seeing? Well, we're seeing here now that price is creating a higher high and a higher low. So that being said, let's say we're planning to continue to trade this. We're looking for a commonality. That may be price coming back to a key level. That might be price breaking above. That might be price creating new points of contact. What do we see here from a trend perspective? Well, we're failing to break. So now we shift to behavior. What are we seeing from a behavioral perspective? Well, we have a structural high. We broke out and broke back in, and we're continuing to fail to break. So in terms of behavioral perspective, we're now seeing that this uptrend could be depleting. What can we do next? Well, we can look for a pattern. Head and shoulders at this point, triple top at this point, a false breakout at this point, whatever you want to call it. Or we can be super patient and say to ourselves, well, I'm just going to wait for something more clearer. Okay, let's continue with the behavior. We see commonality. Let's make this clearer. We have a commonality here. We have a commonality here. And this is our first sign. We have a commonality here and a commonality here and our first sign of here. But what happens? Well, when you come to the charts and you see that price has broken this, we bring all this behavior together. We identify the commonalities that work and hasn't worked because of the break. We see the shift in the uptrend that is depleted in terms of behavioral perspective. And now we start to identify the shift in the structure and behavior of this market. So now we can incorporate patterns. What do we see in terms of patterns? Well, we see price breaking the structural low. So that's behavior. Price pulling back into a key level, which is a trend. And from a behavioral perspective, we see price failing to break back in. And from a pattern perspective, what do we see? A simple break and retest. And we just bring that together. Then we bring in another commonality because we have 1 point here, 1 point here, and then we have a 3rd point here. However you enter this immediately, scaling down techniques, it doesn't matter. It's all the same thing. And we enter the trade. There we have it. So the 5 points, guys. First thing you want to do is find commonalities. Identify recurring market trends and conditions. Second is trade with a bias. Align the trades with the prevailing market direction. The third thing is trade with the behavior. Understand and capitalize on market psychology and sentiment. which doesn't mean you have to have secrets or insights. Include patterns, integrate recognizable price formations into decision making. Finally, when building your strategy, bring everything together. Okay. Make sure you bring all the insights and the data that you've collected and craft a cohesive personalized trading approach that fits you. It's that simple. All right, guys. So before we wrap up, here's a real talk. What I've spilled today isn't your everyday wisdom, but, and that's a big but, it's not a magic pill. Don't just bounce from this video thinking that you'll be on top of your trading and everything will work out for you. You've really got to dive deep, embrace the grind, and track every move. So the upcoming 30, 60, 90 days, refine, redefine, and set up a game plan that's solid. Remember, it's your journey. Pick a pace that fits your vibe and trust in your journey. If you enjoyed this video, please smash the like button, and I'll see you on the next one, guys. As I always say, continue to trust the process.